Welcome back to the Global Ledger. I'm Justin. There's one market in the world that everyone assumes is always liquid, always unified, and always reliable. That is the U.S. Treasury market. It is the benchmark for global interest rates, collateral systems, risk-free pricing, and financial stability itself. But today, we're going to talk about a risk most people don't see, and that is Treasury market fragmentation. Okay, it's not a crash, not a panic. It's a quiet structural break. Let's get into it. Fragmentation doesn't mean the Treasury markets stop trading. It means different treasuries trade at different liquidity premiums. It means identical cash flows stop trading at identical prices. It means price discovery spreads across disconnected venues. The market still functions, but it no longer behaves as one market, okay? Historically, treasuries were unified because dealer inventories were deep. Balance sheets were flexible, arbitrage was cheap, and funding was abundant. If a bond mispriced, dealers stepped in. If liquidity thinned, inventories absorbed it. That world is gone. Okay? Several structural shifts reshaped the Treasury market. Tighter balance sheet constraints, reduced dealer intermediation, heavier reliance on hedge funds and fast money, growing use of futures, ETFs, and swaps. Increased clearing and margin requirements. Okay, the market grew larger, but its shock absorbers shrank. So fragmentation appears as on-the-run versus off-the-run dislocations. It appears as futures diverging from cash bonds. Okay, it appears as repo specials and funding squeezes. Okay, ETFs decoupling from net asset value. None of this looks like a crisis at first, but together they signal stress in the plumbing. Okay? Treasuries are not just assets, okay? They are collateral, pricing anchors, hedging instruments, and liquidity backstops. So when the Treasury market fragments, collateral valuation becomes unstable, hedging breaks down, funding markets seize up, and volatility spills everywhere. This is why even small Treasury disruptions really do matter. Okay, they really matter. Okay, and fragmentation isn't caused by fear. It's caused by limits. When dealers can't or won't warehouse risk, arbitrage weakens, spreads widen, dislocations persist. Markets don't fail because prices are wrong. They fail because balance sheets step back. So fragmentation doesn't make headlines, okay? There's no bell, no panic, no crash, any of that. Just worse execution, higher volatility, unstable funding, and fragile liquidity. It feels like something is off until it isn't subtle anymore. So we've seen how liquidity is conditional. Arbitrage depends on funding. ETFs transmit stress. Dealers are balance sheet constraints. This is the ethos we've been talking about in Arc 8, okay? Treasury fragmentation is where all of those threads start to meet, okay? This is why it was put into Arc 8, okay? And it brings us to a really important question as well, okay? And if the most liquid market in the world can fragment, what does liquidity actually mean? Okay, in episode 79, we'll tackle that directly. I know this was a shorter episode, but we're going to go deeper on things like this, okay? We're scratching the surface on a lot of these topics, but I promise as we start going, we're going to get a lot deeper. I think introducing them in this way is probably the best, most helpful. So in episode 79, we're going to tackle something I call when liquidity is an illusion, okay? Because what looks like liquid or what looks liquid, I should say, on your screen often disappears when you need it most. So thank you for listening to episode 78 of the Global Ledger. We talked about we scratched the surface on Treasury fragmentation, okay, and where it meets and how it connects up with ARC 8. Okay, so once again, I'm Justin, and thank you for being here.